another public limited entity on 1st of April 2024. So then we are told that the acquisition consideration comprised of an immediate cash payment of 2,400 million made on 1st of April 2024, and a further consideration of 1,331 million deferred until 1st of April 2026. This is what we refer to as the deferred consideration. And then you're told no accounting entries have been made in respect of the deferred cash consideration. 𝐓𝐿 Limited has a cost of capital of 10%. And then you're told on 1st of October 2024, 𝐓𝐿 Limited together with another entity entered into a joint arrangement to jointly control 𝐶𝑠𝑠 Limited, a public limited entity, public limited entity. Effectively, 𝐓𝐿 Limited purchased 50% of the equity shares of 𝐶𝑠𝑠 Limited for an immediate cash payment of 1,500 million. The following financial statements relate to the group of companies. So we are given the statement of profit or loss, basically for three companies, 𝐓𝐿, Pepper, and 𝐶𝑠_S. We have the statement of financial position for the three companies, that is 𝐓𝐿, Pepper, and 𝐶𝑠_S. And then we have some additional information. This was actually one of the simplest questions, which has been tested in advanced level for group account. So we're given additional information. You can see actually the additional information, we're just given like 4 additional information. Then what are we required to do? Part A, we're required to prepare the consolidated statement of profit or loss for the year which ended 31st of March 2025, the consolidated statement of financial position as at the same date. Now, before we do that, automatically this is a question for group account. The first thing we need to do is we come up with a group structure. We know the relationship, the nature of investment by the parent company in the other companies. We go through the additional information as we do or maybe we do any working which is necessary. So we go straight to the workings, and basically the first working here will basically be to come up with a group structure. To come up with a group structure. That's the first thing you always need to have in any question for group accounts. The group structure. So where do we have the information about the group structure? This information, we have it within paragraph 1. Let's go back to paragraph 1 of our question, and we are told the company which is called 𝐓𝐿 Limited, a public limited entity, acquired 80% equity shareholding in a company which is called Pepper, a public limited company on 1st April 2024. So the company which is called 𝐓𝐿 Limited, this company acquired 80% equity shareholding in a company which is called Pepper Limited, on which date? 1st of April 2024. 1st of April 2024. It basically means that 𝐓𝐿 is the parent and then Pepper is the subsidiary. You can see also we given the date of acquisition. Then from there, we go to the paragraph number 3. Let's go to paragraph 3. We skip paragraph 2. In paragraph number 3, we are told on 1st of October 2024, 𝐓𝐿 Limited, our parent company, with another entity entered into a joint arrangement to jointly control 𝐶𝑠_S Limited, a public limited entity. Effectively, 𝐓𝐿 Limited purchased 50% of the equity shares of what? Of 𝐶𝑠_S for an immediate cash payment of 15. So this company here, we are told acquired 50% shareholding in a company which is called 𝐶𝑠_S Limited. 𝐶𝑠_S Limited on which date? 1st of October 2024. 1st of October 2024. So it basically means that from this group structure, this will be our parent company, this will be our subsidiary, and basically this one will be a joint venture. That one will be a joint what? A joint venture. So that is the first thing you always need to have, because this is basically what will guide you in terms of how to prepare the group account. So if we go to the requirements, therefore, we are required to prepare the consolidated statement of profit or loss, consolidated statement of financial position. So in preparing those consolidated financial statements, we will add similar items of assets and liabilities, those of the parent, those of the subsidiary. That does not apply to the joint venture. For the joint venture, in the consolidated statement of profit or loss, we will compute the parent company share of profit after tax, another comprehensive income, and also we compute something called the investment in what? In joint venture, or the investment in joint arrangement. This one, we can also refer to it as a joint arrangement because the parent company have a joint arrangement with another company to control this, to jointly control that one. So I think we have that. Then we will be able to come back to that paragraph 2, because we have the aspect of deferred consideration, but we will only come back there when computing the goodwill. So that deferred consideration, remember we said we have to discount it to its present value using the parent company cost of capital. That's why you can see you're given the cost of capital of 𝐓𝐿 Limited. That is for the purpose of getting the present value of that. So I want us to go to the additional information now. Let's go to note number 1. And in note number 1, what are we told? We are told at the date of acquisition. At the date of acquisition, the fair value of Paper Limited, remember Paper now is the subsidiary. Paper Limited net asset approximated their carrying amount with an exception of some office equipment whose carrying amount was 560 million below the fair value. And then you're told at this date, the office equipment had a remaining economic useful life of 8 years. And then you're told depreciation on office equipment is an administrative cost. And then you're told no fair value adjustment were necessary in the acquisition of Caesar. What does that mean? It means that on the date this company was acquired, that is the subsidiary company revalued the assets. Revalued the asset. And if you can be able to recall, we refer to that as the fair value adjustment or the fair value exercise. And actually, we said once the subsidiary company revalues the asset, the subsidiary company does not account for that revaluation. As a result of that, when preparing the group account, we talked about 2 key consolidation adjustments we make. The first one is called the revaluation adjustment, which is an adjustment relating to the revaluation gain, and the other one is depreciation adjustments, whereby you have to compute depreciation and the charge. So therefore, we need to do some working as far as that is concerned. Note 1 is concerned, which you are saying is a fair value adjustment, or basically the fair value exercise. Let's just refer to it as the fair value adjustment, and this is by Paper Limited. By Paper Limited. So we need to make 2 adjustments as far as this is concerned. The first one is called the revaluation adjustment. And basically, this is the adjustment in relation to the revaluation gain or loss. But remember, you see in most of the questions for group account, you will come across a revaluation gain. So that's why we are told in the first paragraph, in the first sentence of note 1, we are told at the date of acquisition, the fair value of Paper Limited net asset amount, with an exception of an item of office equipment whose carrying amount was 560 million below. So this one was below or was less than fair value with 560 million. In other terms here, we can say the fair value, we start with the fair value, then we change this inequality sign. Remember, this was less than. So we change this now to greater than. If we start with this, so this one will be greater than carrying amount with an amount of what? 560. So if the fair value of an asset is more than its carrying amount, automatically that is a revaluation gain. So the fair value of this item of office equipment was more than carrying amount. Remember, carrying amount, this one can also be known as the net book value with an amount of 560 million. So because this revaluation, okay, this 561, we are saying this is a revaluation gain. This is a revaluation gain by Paper. Did the Paper Limited accounted for this revaluation gain? No. So therefore, in preparing the consolidated financial statement, this one will be added to the group PPE. And number 2, we say that this one is a pre-acquisition revaluation reserve. Being a pre-acquisition revaluation reserve, we use that in the computation of goodwill, because we say in computing the goodwill on acquisition of this, we need to have we need to compute its fair value. We need to compute the fair value of its net asset on the date of acquisition. How do we compute that? We take the ordinary share capital of the subsidiary plus pre-acquisition reserves. This will be one of the pre-acquisition reserve. Next, we need to compute something called the depreciation other charge. Depreciation other charge. other charge, and equally this depreciation other charge will be by paper, is by paper limited. So you need to recall the formula. There is a formula which I gave you here. That is basically what you need to remember. We said we take the revaluation gain, divided that with the remaining useful life of the asset, and then we multiply this with what? With the proportion of time. The proportion of time is basically the time we have, or basically the number of years, the number of months we have from the date of acquisition, the date of DOA, to the date of consolidation. Remember, the date of acquisition is the date the subsidiary was acquired. The subsidiary was acquired on which date? There, 1st of April 2024. The date of consolidation, this one, DOC, this is the date we are required to prepare the group accounts. And if you go to the requirement, you'll be able to see when are we required to prepare the group accounts as per the requirement. The year which ended 31st of March 2025. So that is the date of consolidation. And actually this year, because the year of the group is ending at 31st of March, it starts on 1st of April. So this year started on 1st of April, 2024. So therefore you can see our subsidiary here was acquired exactly at the start. Was acquired exactly at the start of what? Of the year. So therefore, the proportion of time we have here will be 1 year. Will be one what year? We're interested with the depreciation other charge for 1 year. We will take the revaluation gain, which we have here, 560 million. We are applying this formula. We divide that with the remaining useful price. And I hope you can see that within note 1. Can you see the remaining useful price? How many years? In note 1, remaining useful price. In note 1, how many years? Who can see that? Who can see that? Who can see that? 8 years. The remaining useful price of that asset. Can you see that? Should be 8 what? 8 years. 8 years. So we divide that with 8. And then the proportion of time here we are saying is 1 what? Is 1 year. If, for example, in our case, we had 6 months here. We had 6 months. So then the proportion of time here is always 6 over 12. If we had, for example, 2 years, we're interested in the depreciation other charge for 2 years. Our proportion of time should be 2. Should be what? 2. But in our case, we're interested with depreciation other charge for how many years? For 1 year. For 1 year. For 1 year. So this will give us 70 million. Now, this 70 million, which items will be adjusted here? One, this one will be deducted from the group PPE. When preparing our consolidated statement of financial position, we left that from the PPE. Number 2, we will also deduct this from the retained earnings of which company? Of paper. Retained earnings of paper. And number 3, in preparation of the consolidated income statement, because we are required to prepare that, the consolidated statement of profit or loss, this one will be adjusted where we have said any depreciation other charge should be added to the cost of sales unless otherwise. If you check on the information which are given in note number 1, we are told that depreciation of the office equipment is an administrative expense. Are we going to add this to the cost of sales? No. No. So in this case, we will add this depreciation other charge to what? To the administrative expenses. To the administrative what? Expenses. But if the question was cited, that one should be added to the cost of sales. So we are done with that. This is something which you have to understand because in all questions for group account, you will come across this particular concept that the subsidiary company revalued the asset but never accounted for that. Which adjustments are required? 2, the revaluation gain and the depreciation other charge. Let's move to point number 2, where we are told 𝐎𝐿𝐶 Limited, which is basically the parent, measures the non-controlling interest in subsidiaries at the fair value. This is something I explained that if you come across that information that it is a policy of the group, it is a policy of the parent company to measure NCI at fair value, that information is basically to help you in computation of goodwill. And who can tell us, based on that information, which method are we going to use in the computation of goodwill? The goodwill on acquisition of this subsidiary. Which method are we going to use? Are we going to use the partial goodwill method? Are we going to use the full goodwill method? Which method are we going to use based on that information which we have there? Based on that information, which method are we going to use? Maureen, Georgina, which method? Benson, Gilbert, which method are we going to use? Automatically, we are going to use the full goodwill method. the full goodwill method. That's why still in point number 2, we are told the fair value of the non-controlling interest of paper limited at the date of acquisition was 860. That is for the purpose of computing what? The goodwill. That is the NCI fair value. So no working which is required there. Let's move to point number 3. And you're told during the year which ended 31st of March 2023, Paper Limited sold goods to Rock Limited for shillings 500 million at a markup on cost of 25%. First of all, this goods which was sold by Paper Limited to Rock, this one we refer to that as amount of intragroup trading or intragroup sales. Intragroup trading. And basically we are told the goods which were sold by Paper to Rock, they had a value of 500 million. So basically we have said that these sales between the parent and the subsidiary are fixed sales. So therefore this one will be deducted from the group revenue. This one will be deducted from the group revenue. And number 2, we will also deduct this from the group cost of we have the marine insurance and so on. So all those types of insurance business, they fall under what you call the general the general insurance. So now the insurance companies, or basically those particular companies which undertake insurance business, at the end of each year, they are expected to prepare financial statement. And the financial statement prepared by these insurance companies include: number one, we have the revenue account. Number two, we have the general statement of a profit or loss, or basically the income statement. And number three, we have the statement of financial position. So let's start by looking on what we mean by the revenue account. The revenue account. Now, the revenue account, basically, this is an account which is prepared to determine the performance of each insurance business. Assuming we have an insurance company which is maybe providing two insurance business, the life insurance and maybe the fire insurance. So those are two different insurance business. So the insurance company would like to know at the end of each year, how is each insurance business performing? So such an insurance company will prepare something called the revenue account. So therefore, this is basically prepared. This one is prepared to do what? To determine the financial performance of each insurance business. So how do we prepare this particular account here? I want us to look on the format, and then I will be able to explain how we compute a number of items. So this particular account is basically prepared using a vertical format, not the T format. So the revenue account. So assuming our insurance company basically undertake two insurance business, maybe like the fire insurance, or provide two insurance business, the fire insurance, and maybe the life insurance. So basically in that case, we have two columns here. And when preparing yes, I hope now it is clear. Yes, so basically what I'm saying here is that this is basically a contract which is entered into between two parties, the insurance company and basically insured, and the insurance company basically undertakes the insurer on the a contingency, or basically on the uncertain event. The insured on his part basically commit himself to be paying some periodical payments, which are known as what? The premiums. So therefore, it's a contract between two parties, the insurance company or the insurer, and the insurance company undertakes to compensate the insured on the happening of a future uncertain event, and this person on his part must be paying some periodical payments, which are known as what? The premiums. Now, these insurance companies usually provide various types of insurance businesses, and those insurance businesses are usually classified into two. So mean that we have two types of insurance business. Majorly we have two, or they are classified into two. We have the life insurance. And when we talk about the life insurance, this is a type of an insurance contract whereby the insurance company basically undertakes to compensate, or basically to pay the insured a certain amount of money, which is known as a lump sum, upon the insured attaining a certain age, or basically upon his death, whichever occurs earlier. So in this case now, a lump sum will have to be paid to the insured either upon attaining a certain age, or basically upon his death, whichever will occur earlier. Then from there we have now the general insurance. So when we talk about the general insurance, this refers to any other insurance business other than the life insurance, or the life assurance. And therefore, the general insurance, this includes insurance, burglary insurance. You have a business, you insure your business against theft. We have the fire insurance, we have the motor vehicle insurance, we have the marine insurance, and so on. So all those types of insurance business, they fall under what we call the general insurance. So now the insurance companies, or basically those particular companies which undertake insurance business, at the end of each year, they are expected to prepare financial statement. And the financial statement prepared by these insurance companies include: number one, we have the revenue account. Number two, we have the general. Yes, I hope now it is clear. Yes, so basically what I'm saying here is that this is basically a contract which is entered into between two parties, the insurance company, or basically the insurer, and basically another person who is called the insured. And in this contract, the insurance company basically undertakes to compensate the insured on the happening of a contingency, or basically on the happening of a future uncertain event. And now the insured on his part basically commit himself to be paying some periodical payments, which are known as what? The premiums, which are known as what? The premiums. So therefore, it's a contract between two parties, the insurance company or the insurer, and the insurance company undertakes to compensate the insured on the happening of a future uncertain event. And this person on his part must be paying some periodical payments, which are known as what? The premiums. Now, this insurance
If you can hear me, then you respond with a yes. Good evening, Anne. Good evening, Aziz. Good evening, Sharon. Good evening, T. Good evening, VMM. And good evening, Walter. Can you hear me? You respond with a yes if you can hear me. Perfect. So we stopped at what we call taxation across the borders. And the last statement that we basically made, we talked about individuals that are basically affected by what we call double taxation. One of it, we say that these are citizens that basically work abroad, or one of the few people that are affected by double taxation, citizens working abroad. We have what we call the expatriate employees working in Kenya. We have sportsmen or professionals, sportsmen and entertainers that basically earn income from abroad. Then we have businesses that are carried partly in Kenya and partly outside Kenya. So then we get to what we call the objectives of double taxation agreements. What we call the objectives of what we call double taxation agreements. Objectives of what we call the double taxation agreements. So what we call the objectives of what we call the double taxation agreement. So what do you think are the objectives of what we call double taxation agreements, where two countries engage into agreement for citizens probably working in those two particular countries? One of which is basically to attract investment. To say to attract investment. So basically, when you're taxed on both ends, will that be able to attract investment? Let's say, for example, there is the two countries, for example, Kenya and let's say China. and you do not have double taxation agreements, what happens? It basically implies that you're going to be taxed double. And in that scenario, do you think we'll be able to attract what we call investment? We will not be able to attract investment. So we say to attract what we call skilled manpower, to attract what we call skilled manpower. To basically attract what we call the skilled manpower as a second, to attract what we call the skilled manpower, then to protect citizens of a country, protect, say to protect what we call citizens, we say of a country, we say from what we call from double taxation, to basically protect citizens of a country from what we call the double taxation, to protect what we call the citizens of a country, we say from double taxation. We can also say to facilitate, we say to facilitate what we call free movement, we say of labor, to facilitate what we call free movement of labor. In instances where an individual is taxed double, in cases where countries do not have what we call the double taxation agreement, people will not easily move altogether. Then say encourage citizens of the country, encourage what we call citizens, say of a country to look for jobs, for jobs abroad. So this definitely will encourage what they call the citizens of a country to basically look for jobs abroad because of these agreements. Together, team. If you're together, then you just give it a yes. If we are together, then we give it a yes. So what are some of the countries, VMM, switch off the video. What are the countries, some of the countries that Kenya basically have what we call a double taxation agreement with? What are some of the countries that Kenya basically have what we call the double taxation agreement? What are some of the countries that basically Kenya has what we call a double taxation agreement? For sure, United Kingdom, Kenya has what we call a double taxation agreement. We have India. We have what we call the East African Community, that is Uganda, Tanzania, Burundi, and Southern Sudan. We also have Sweden. These are some of the countries that basically Kenya has what we call a double taxation agreement. And the essence of those agreements, we've talked about the objectives of those agreements on this particular. So I want to talk about what we call conditions to be met. Conditions to be met. We say to be met. We say in order to qualify, in order to basically qualify for what we call for double taxation relief. So we have what we call conditions to be met in order to qualify for what we call the double taxation relief. Then in order to qualify for double taxation relief, there are certain conditions that must basically be the certain conditions that we understand that must basically be met in order to qualify. What are these conditions that basically must be met in order to qualify for what we call double taxation relief? What are these conditions that must be met? So in order to qualify, tax must have been paid in other countries altogether. If you're Kenyan, the tax must have been paid in other countries. So the first one, we say the tax must have, we say, been paid. The tax must have been paid in that, we call it other country. The tax must have been paid in that other country. On income, we say subjected to what we call to double taxation. On that income that are basically subjected to double taxation, that the tax must have been paid to that other country, basically on that income that we understand is subjected to double taxation. Number two condition will basically say that double taxation relief, taxation relief, we say should not exceed. So what you call the double taxation relief should not exceed what you call the tax payable in what call in the home country. But the double taxation relief should not exceed tax paid in the home country on income subjected to double taxation, on the income that we understand is subjected to double taxation. In most of the questions, you'll always find that the tax on other countries is lower. Are we together? As compared to the same income subjected to taxation in Kenya. Together, team, we respond with a yes. If you're together. Are we together? So the third, there must be what you call the double taxation relief policy. There must be double taxation. There must be what you call the double taxation relief policies, say in the country. There must be what you call double taxation relief policy in the country. There must be what you call the double taxation relief policy, and we understand in the country. Then we say we have four that we call time limit. Number four, we understand the time limit of making the claim, of making what you call the claim, of making claim, we say for a relief, time limit for making claim of relief is usually we understand 6 years since the tax payable was paid in what's called was payable in that other country, in relation to income, was 6 years since the tax payable was paid in other country, in relation, we say in relation to double taxation, in relation to what we call double taxation, in relation to what's called the double taxation. Those are conditions in order for one to qualify for what we call the double taxation relief. We respond with a yes. Together. We respond with a yes if you're together on those conditions. We give it a yes if we are together. Ouko, are we together? I'll say it on those conditions in order for one to qualify for double taxation relief. The tax must have been paid in that other country on income subjected to double taxation. There must be double taxation relief policy. And we basically said that the double taxation should not exceed the tax payable in the home country subjected to what we call the double taxation. So we get to what we call areas covered by double taxation agreement. areas we say covered by what you call double taxation, areas that are basically covered by the double taxation agreements. Areas that we understand are basically covered by the double taxation agreement. And so one of the areas we basically say persons covered by the agreement. We understand the next is taxes covered by the agreement. Incomes that are affected by what we call the agreement. We have what we call terminations of agreement. Are we together? Terminations of agreement. So we can what we call one is persons covered by agreements. Persons that we know are covered by agreements. Number two, taxes. We understand covered by what we call agreements. Taxes are basically covered by agreement. Then number three, we have what we call incomes. Incomes, we understand affected by what we call the agreements. Incomes that we understand are affected by the agreement. You also have another area what we call terminations. Terminations of what we call agreements. Terminations of agreements. So then we have aspects of determination of residence of a taxpayer. Aspects of determining what we call residency of a taxpayer. Together, we respond with a yes, basically on areas that are basically covered by double taxation. Together, team. FJ, Lenovo, Mary, and the rest of the class. Tuko pamoja. If you're together, then we respond with a yes. So then if you're together, then give me a yes. So then we go to forms of double taxation relief agreements. What we call forms of what we call double taxation agreements. Forms of what we call the double taxation agreements. What we call the forms of double taxation agreement. One of the first form, we have it as unilateral. We have the first form, what we call unilateral relief. So when you say unilateral relief, what do you basically mean? Unilateral, before you get to bilateral, what do you basically mean by unilateral relief? Unilateral relief. I hope Miriam is in class. I hope Miriam is in class. And I hope Chengo is also in class. Perfect. And I hope Chengo is also in class. Yes, perfect. And I hope Gilbert is also in class. I hope Gilbert. Elvis is also in class. I hope Elvis is also in class. Perfect. Our representative, Sheila, I hope she is also in. So when you talk about unilateral relief, what do you basically mean by unilateral relief? Unilateral relief. When you say unilateral relief, we say this is where we say that the government, this is where the government, we say that this is where the government decide to grant, decide to grant what they call relief, decide to basically grant relief to its citizens, working abroad, decides to grant relief to its citizens working abroad who are subjected, we say who are subjected, were subjected to what we call double taxation, were basically subjected to what's called double taxation without considering. Unilateral touches on one aspect. We say without considering. We understand that without considering whether other governments grant what they call their citizens, working in the country, double tax relief. And that is simple. What are we trying to say? That when you talk about unilateral, you basically grant you grant to your citizens working abroad, you grant them relief without considering that the expatriates are granted relief by their countries altogether. That is basically what's called unilateral relief. Together, we respond with a yes. We respond with a yes if you're together. So then we go to bilateral. What they call the bilateral reliefs. So what is bilateral relief? What they call the bilateral relief. What they call the bilateral relief. So what is the bilateral relief? What is a bilateral relief? What is a bilateral relief? When you say bilateral relief, what do you basically mean by the word bilateral relief? Somebody try. If we understand this, then this should be simple. So who can give us this? If you understand the unilateral, then bilateral should be very simple. So what is bilateral? So bilateral, two countries basically considered. Bi means two, not more. Bi basically means two countries. Mary, when you talk about bi, basically means two countries. Are we together? They are in agreement. Not only one country is in agreement to grant its citizens, both parties are basically involved. And that is to say, this is where, this is where we say two, this is where two or more countries, but specifically by should be two or more countries negotiate, and you say conclude, negotiate and conclude what they call the double tax relief. Negotiates and conclude what's called the double tax relief, the double tax relief agreement, double tax relief agreements to say where the citizens, where we say the citizens, where the citizens working in these countries, working in these countries are granted what they call the double taxation relief, where citizens working in these countries are basically granted relief. So they basically say, even when you say more countries, so more countries could have Kenya, we could have Kenya and maybe China, we can have Uganda and Kenya, but they're coming in agreement together, where those personnel from the country working in both countries are basically granted what they call the double taxation relief. On the unilateral, what you say that if we are talking about unilateral, we grant this relief to personnel, basically Kenyans working abroad, but you don't consider whether those other countries are providing relief to their people together. So we go to the methods of determining double taxation relief. So we go to the methods. We call it methods of what we call of determining what we call the double taxation relief. So methods of determining what we call the double taxation relief. What are the methods that we basically have to determine what we call the double taxation relief? So there are basically two methods. We have the exemptions method, and then we have what we call the credit method. So we have number one, we call it exemption. We call it the exemption method. And number two, we call it the credit. We call it the credit method. So we have what we call the exemption method, and then we have what we call the credit method. So we have what we call the exemption method, and we basically have what we call the exemption method. We have what we call the credit method, and then we have what we call the exemption method. I want to start with the exemption method. To exempt, what does it mean to exempt? To exempt, what is exemption? When you say to exempt, not charge tax, perfect, Mary. So we have the first method, and we're calling it exemption. We are calling it the exemption method. We are basically calling it the exemption method. So the first method, we call it the exemption method. So we're saying in this, we say income. In this, we basically say that the income, and this the income, in this the income, say and abroad, and we say affected, and affected by what we call by the double taxation, and affected by what we call the double taxation, we say is not subjected to what we call tax. So basically, we're saying that the income that is earned abroad and affected by what we call the double taxation, the country will not basically now subject it to tax in the home country, to tax in what we call the home country. Will not subject it to tax in the home country, as long as, we say, as long as the tax was paid in what we call in the source, as long as the tax was paid in the source country, as long as the tax was paid in the source country, as long as the tax was paid. So say the country, source country is country where the income, we say was generated. So source country is the country where the income was basically generated. The source country is basically the country where the income was generated, where the income was basically generated together, where the income was generated. All of us are together. I want to pose a question. If you're together. Perfect, if you're there. So the question is altogether. I believe there's much closure in terms of now you understand what happens altogether. What happens if you have maybe family members abroad altogether? When you have family members abroad, are we together? When you have what you call a family members abroad, are we together? are moving, when you have what's called family members abroad, are we together? And the questions pertaining to what we call tax, how do you go about it together? In cases where there have been, how would you go about it practically? In case, for example, we have what we call an exemption clause altogether, but they have a PIN. What are you going to do? When you look at two countries, you have what we call an exemption clause. What are you going to do in scenarios where we have what we call an exemption clause? But they still have a PIN. So that PIN, what are you going to file on that PIN? On that PIN, there's not an income that was generated in Kenya. The whole of their income was basically generated abroad, but we have in scenarios where we have exemption clause. With that PIN, what are you supposed to do with that PIN in terms of now filing taxes? So what are you going to do to that PIN? That is the question. What are you going to do to that PIN? We respond with a yes. What are you basically going to do with that PIN? Kindly, what are we going to do with that PIN? So basically, it's say exemptions altogether. Exemption is basically exemption. You ask for a refund. You ask for a refund. Why should you be refunded? And we have what we call exemption clause. I want to expound on the exemption clause. We are basically saying that as long as you are paid, you are a citizen. Yes. Yes, perfect. With supporting exemption certificates altogether, with supporting exemption certificates altogether. In that case, what are you going to file? What are you going to file? I know practically there are a few areas of application and a number of things. Practically, not many people make this disclosure. Is that true? Practically, not many people make this disclosure. Is it true? When it gets to this area, how do you find, for example, for those brothers who are not here? Yes, they definitely file nil altogether. But again, you need to provide maybe along the way, you need to provide those supporting documents altogether, especially when we have what we call exemptions altogether. Those supporting documents implying that there is what we call exemptions between those two countries. Then you have what we call the credit method. The credit method, we have what we call the credit method. So on the credit method, this is where a majority of the questions basically come. When you have the credit method, this is where a majority of the question comes. So we say in this case, we say that the tax paid, basically in this case, the tax paid in that other country, the tax that is basically paid in that other country. So what we call the source country, stroke the source country, on income, subjected, on income, we understand subjected to double taxation. On income that is basically subjected to double taxation. On income that we understand is subjected to double taxation is granted. We'll say is granted as relief in relation to tax payable, on relation to tax payable in what call in the home country. We say on income, subject to what we call double taxation, taxation. So I just want to remind us on something. We say conditions that have to be met. What did I say about condition 2? Conditions that must be met in order to be granted what we call the double taxation. In order to be granted what we call double taxation. I think it was condition 2. That was condition 2. What did I say on that condition 2? That the tax that you're basically paying abroad should be less than the tax that you're paying in the home country. Are we together? So that tax that you're paying in the source country, you are basically granted. It is always what you call the law, the lower. It is always what you call the law, the law. Together, team. That's why you say that the tax that you basically paid abroad will be granted as what you call relief. It will be granted as a credit, as a tax credit. We'll respond with a yes if you're together. Will be granted as a relief. Basically, with our condition number 2. Basically, condition number 2. We'll respond with a yes if it's here. Subject to condition 2. Perfect. So I want to ask to determination. Now then we get to question, determination. Determination. We'll call it determination. Determination of tax. Determination. What we call determination of what we call tax. Tax of double tax. What we call the double tax relief. Determination of what we call the double tax relief in Kenya. Determination of what we call the double tax relief in Kenya. And what we call determination and determination of what we call actual tax, of what we call actual tax payable, and what we call the actual tax payable by what we call persons. Persons, we say affected by persons that we say are affected by what we call by double taxation. By double taxation. By double taxation. We understand those persons that are affected. Are we together? Do we understand on those persons that are basically affected by what we call the double taxation? Persons that we say are affected by what we call the double taxation. We know the persons that are affected by the double taxation together. Is there a question on those who are affected by double taxation? Or that was exhausted perfectly well? Was that exhausted perfectly well? On persons that we understand are affected by what's called the double taxation. Perfect. So how do we determine, based now on the credit method, double taxation relief and the actual tax payable on the persons that are affected by what we call the double taxation relief? Number one, the double taxation relief is comparison altogether. The tax that was basically paid on the source country, that is basically income that was earned abroad. Then you put that income in terms of the Kenyan system and you get the tax that is payable. Are we together? You get the tax that is payable. Remember, under the intermediate, we basically say that for resident, their employment or for business that are partly operated in Kenya and partly operated outside Kenya, we say that both incomes are basically taxed in Kenya. And the big question is that, is this now double taxation? And how do we sort those issues? Does this basically provide solution to those issues that we talked about on intermediate? Does it provide solution? If you remember, for those that I taught on the intermediate, does this provide solutions to those? Does that provide solution to that? Because the question is, if you say that you'll be taxed here and taxed that on the other side. What if you're taxed on the other side? How do we go about it? Which can. But first on that determination of the double taxation relief, we understand that the double taxation relief is basically the tax that was paid on the source country. That is the tax that is paid in abroad, which in our case we understand that if you subject that income that was earned abroad in terms of taxation in Kenya, the tax that is paid in Kenya should be higher. Because the tax that was paid outside the country should be lower on the condition. Then how now do we determine the tax payable for these persons that are affected by the double taxation relief? So we understand that the double taxation relief, once we get it, we compare the tax that was basically paid abroad and the tax that was paid in Kenya. And we understand that the tax that is basically paid abroad is lower. We are going to use that tax that was paid abroad as what we call the tax credits. Together, team, we are going to use it as the tax credit. You give me a yes if we are together. You give me a yes if we are together. You give me a yes if we are together. And we basically said on these classes that the most important thing is to understand the concept. It's not a question. The most important thing is the concept behind what you're about to do. So once we get the concept is the most important thing that we need to focus on. Once we get the concept right, we don't have to be perfect. We can go step by step. You can miss one step altogether, prayer break. Can we take it now, or we give Aziz, you can allow us to finish this? Or class, are we in agreement that we take a break? Are we in agreement that all of us will take a break? Can we? So Aziz, you okay? You'll get us back. We also don't want to leave Aziz. So what we do, we grant the break to, we respect it's time for prayer, and then we come back. So we give our 10 minutes. When you come by 7:01, yes, it's okay. Ouko, you're making the class lively. It's okay. So we can take our break so that we also respect it's time for prayer. The double tax relief is basically the law. One is tax payable. We call it tax payable. We say in Kenya, tax payable in Kenya on income. We say subject on incomes that we basically say subject to double, subject to what we call double taxation on incomes that we understand are basically subject to what we call the double taxation on incomes that we say are subject to double taxation. So you compare with the tax on what we call on the source country, tax on basically what we call the source country. We say on income, we say subject to what we call double taxation on income that we understand are subject to what we call double taxation together. So which on the condition, we basically know that the relief will be the tax that is from the source. So we say the steps in determining, we say in determining what we call the double taxation, steps in determining what we call the double taxation relief, and what we say and what we call the actual tax payable. So the steps that we use to determine the double taxation relief and actual tax payable by the taxpayer. And the actual tax, we say payable by the taxpayer, and the actual tax that we understand is payable. So I want us to be very keen on those steps. I want us to be very keen on these steps. I want us to be very keen on these steps. I want us to be very keen on these steps. So look at those steps. I want us to try and finish those steps by, in the next 10 minutes, we finish those steps. So the first step, number one step, we say that determine the taxable employment. Determine what we call the taxable employment. Income, we say earned in Kenya. That is number one, determine what you call the taxable employment income earned in Kenya. So number two, we say determine what you call total tax payable, total tax payable on income and in Kenya. So when you say the total tax payable, what do you basically mean? When you say the total tax payable, what do you basically mean? That is employment plus investment income. That is what you call the employment plus what you call the investment plus the investment income. So we have the employment plus what you call the investment income, employment plus what you call the investment income. Together, team, employment plus the investment income. So then with determination of tax payable, number three, we call it determination of what we call tax payable to income of tax payable of income, we say earned in Kenya, and what we call the outside Kenya. So determination of tax payable of income, this one was basically in Kenya. But point three, we also include what we call the income earned outside Kenya. Together, team, income that is earned outside Kenya. We respond with a yes if you're together. So income that is earned in Kenya plus income that is basically earned outside Kenya. Together, income that we know is earned in Kenya and income that is earned outside Kenya. All of us tuko pamoja. So number one was employment income. Number two, you include employment plus investment. Then number three, we also include now the income that is earned outside Kenya. Together, Robert, Norbert, and Gilbert Mitich. Together, if you're together, we respond with a yes. So we have this was taxable income, so taxable income. This was determination of taxable income of income earned in Kenya and income earned in Kenya and outside Kenya. Number two, determination of tax payable on income earned in Kenya and outside Kenya. Then number four, we say that determination of total tax, we say determination of what we call of total tax on what we call on total income, total tax on what we call total income, and in Kenya, and in Kenya, and in Kenya. So this is the taxable income, but now you determine the tax altogether. This is the taxable income. Remember, this is taxable. That's why I changed taxable income. After taxable income, you determine what you call the total tax on income earned in Kenya, and what you call outside Kenya, on income earned in Kenya, and that is earned outside Kenya. So say that is determination of total tax on total income. Determination of what it called total tax, we'll say on total tax on what you call on total income. So after determining what you call the taxable income, that is both in Kenya and outside Kenya, so you determine the tax that is payable on the total income. Then 5, determination, we get determination, we say determination of tax income, and in Kenya. Determination of what you call the tax income and in Kenya. So I want to ask a question. The difference between this and this, what does it give us? The difference between number 4 and 5, what does it give us? The difference between 4 and 5, what does it give us? The difference between 4 and 5, what does it give us? So 4, we basically say that is the tax payable for income that is basically paid for income earned in Kenya. Yes, it's the tax on income abroad altogether, or the relief altogether. So that is the tax that is charged on abroad, which is the relief. That is the tax that is charged abroad, or what you call the relief altogether. So that determination. Then 6, we say this. We say it determination. We say determination of tax, we say on income. Determination of what's called tax on income. And outside Kenya. Are we together? Outside Kenya. Determination of tax on income outside Kenya. So tax on income, we say, and outside Kenya. Tax on the income and outside Kenya is basically equals to what they call tax on what they call total income. Tax on what they call total income. And we say in Kenya, and what's called outside Kenya. So tax on income and in Kenya and outside Kenya, minus what's called tax on income, we say, and in Kenya. And that is basically difference. We understand difference between 4 and 5. So that is the difference between 4 and 5 together. So the difference between 4 and 5 gives us the tax on income and outside Kenya, which is the relief. So that is the difference between point 4 and 5 together. And that is what we basically call the relief. Chengo tuko pamoja, Lenovo. If you're together, you give me yes. If we are together, you give me a yes. Kindly. I hope we are together. Perfect, Chengo. We are about to be done. Then we pick a question. Thank you, Lenovo. Then 7, we say that we call it determination of what we call of double taxation. We call it relief. determination of what we call the double taxation relief, determination of the double taxation relief, determination of the double taxation relief, which is taken, which we say is taken, we say as the lower, which is taken as the lower of. So you compare two things, which is basically taken as the lower of. Tax paid on source country, tax paid on what you call on the source country, on income. On income, we understand that subjected to double taxation. So say tax on income on the source country, tax paid on source country, on the income subjected to double taxation, on the income subjected to double taxation. Then B or 2, we call it tax payable. What do you call the tax payable? In Kenya, tax payable in Kenya on income. On income, we understand subjected to what we call double taxation. And we always understand that it should be the law, because on the condition, if you compare the tax that is paid on the source country and the one that is paid in Kenya, this one is always the law, and that is what you call the relief altogether. Then say 8, that is 8, we call it determination of actual tax. We call it actual tax payable. Determination of what we call the actual tax payable. Determination of what we call the actual tax payable. Determination. We call it determination of what we call the actual tax payable, of the actual tax payable in Kenya. Determination of the actual tax payable in Kenya is, we say determined as follows. Is basically determined as follows. So say actual tax payable in Kenya. So the actual tax payable in Kenya is usually equals to, that is the tax on what you call on total income. The tax on total income. Total income is from abroad and Kenya. That is from abroad in Kenya. That is basically from abroad in Kenya, minus what you call the tax credits. Minus what you call the tax credits. Minus the tax credits. Minus the tax credit. And I open the brackets just to get those tax credits. As I open the bracket, one of the tax credits is pay as you earn. We have insurance relief. We have personal relief, and what you call double taxation relief, and what you call the double taxation relief. So again, that tax, if you compare the tax that is paid on income from abroad, the tax that is paid in Kenya, and the tax that is paid from the source country, we say the law, which is basically the tax that is paid from the source country, we need to less it, so that we introduce another tax credit, which is called the double taxation relief. Is that understood as we pick on a question? I want us to pick on a question. Is there any question before I get to, before we start on actual testing on that? Is that understood? Tumeelewana? Tuko sawa? Are we together? Perfect. Chengo tuko sawa? VMM tuko sawa? Tax credit. No, I'm saying, Aziz, why do you say pay is not a tax credit or a setup? Why do you say it's not a tax credit? Why do you say it's not? Why do you say the tax pay is not a tax credit? Yes, on individual. Say on individual. Are we together? So we basically, when you say on individual, we understand that as a tax credit. Most of these questions basically touch on individual. As is most questions, particularly on taxation across the borders, most questions are formulated for individual. That's why we include it there. Is that noted as is? So I want us to pick the question. I think the question that was the last time that was in December. Check December question 5. Is Ambucha in class today? The last time, the latest was set in December 2024. Check for me December 2024, question 5. December 2024, question 5. Check December 2024, question 5. Companies who can have installment tax. OCO, installment tax. Installment tax. OCO, companies, installment tax. We basically have the installment tax. Perfect. So I've said December 2024. If you look at the latest question, I normally start with those questions. Latest question. Do you have that question in question 5C? Nemeshukuru, thank you so much. So all of us, let's get that question 5. All of us, let's get that question 5. All of us, we get that question 5. Question 5, we say C. Yes, question 5C. So we call it deck 2024, question 5C. Kama tuko hapo tubonyeze yes. If we are there, then we respond with a yes. If we are there, then we respond with a yes. Allow me to open that question. Just a minute. So we are being told, Tamala Nyambura is a resident of Kenya. And you're being told that during the year ended 31st December 2023, she received the following income. She received what we call the following income. So number one is from employment in Kenya. The figure was 720. Then we have from employment in Zambia. The figure was shillings. The figure was shillings. The figure was shillings. We have it as shillings by 40. When you say net of 78 paid as tax, net of 78 that was basically paid as tax. So net, what does it mean when you say net? When you say net, what does it basically mean? When you say net, what does it mean? You add to get the gross profit, Aziz. Assume that Kenya, you're told that assume that Kenya has what you call, assume that Kenya has double taxation agreement with Zambia. And then you say that the income from Zambia has already been converted into Kenya shillings. So the figure that we're given is already converted. Some questions are we together? Some questions there's no conversion. But for this particular question, the income is already converted. And this question is very small, very, very small. However, it's a good one to kickstart. Is that okay, Aziz? It's a small question, but it's a very good one to kickstart. So then you're being told required compute what's called the double taxation relief due to Tamala, the double taxation relief due to Tamala, and the net tax payable, if any, and the net tax payable, if any, for the year ended 31st December 2023, and the net tax payable, if any, for the year ended December 2023. We can use our procedure. Are we together? We can use, so we can have it Tamala Nyambura, Tamala, we call it Nyambura. Taxable income, we call it the taxable income. We say for 2023. Tuko hapa. Taxable income for 2023. For the income that is basically earned in Kenya, we only have employment income. Do you have investment income? Do we have investment income? Or do we have investment income? There's none. So this was a much easier question. So taxable income in Kenya. So we have employment income, what we call employment income. We have it in Kenya. So what is the employment income in Kenya? Give me the figure for the employment income in Kenya. Give me the figure for the employment income. For the sake of entries, what is the employment income in Kenya? The figure is 720. The figure is 720, but you don't have investment income. So then the next is employment income. Employment income. Employment income, we say in Zambia. Employment income in Zambia. So do we give the net figure or the gross figure? Do we give the net figure or the gross figure? The gross, what is the gross? You add back the net. Add back the net to get the gross. So the gross figure should be 540 plus 78,000. So what is the gross figure? Give me the gross figure. So the gross figure is 6. So somebody gives me a 618. Do we have 618? 618. Then I want us to get the total tax, total taxable income. Total taxable income. Total taxable income. Total taxable income. So that should be 1338. 1338 together. So then you get the tax payable on the total income, tax payable. I want to use that format, tax payable. I want us to get the tax payable. I want us to get the tax payable. Pick up a merger on the tax payable. On the tax payable. Took up a merger on the tax payable. We respond with a yes. So I want us to picture the tax table for us to get the tax payable on the total income, the tax payable basically on the total income, the tax payable. Do we look at, where do we look at? Do we look at monthly or annually for individual? Do we check the monthly or annually? Where do we check? Do we check monthly or annually? To Nangalia monthly or annually? Which one would you use? Mary. Remember, these incomes are for the whole year, so we use annually. So on that tax table, Angalia Malipa annually. So we told that the first 288 we tax at 10%. So what is 10% of 288? What is 10% of 288? What is 10% of 288? So the 10% of 288, that should be 28,800. We respond with the yes if you're there. 28,800. Tuko pamoja. Perfect. Then the next we're being told that between 288 and 388 is 25%. So that should be 100,000 times a figure of 25% times a figure of 25%. What do you have? 100,000 times a figure of what you call 25%. 100,000 times a figure of 25%. What do we have? So that should be 25K. And I hope everybody's following. Are we together? I hope everybody's basically following. So then we're being told that once we have that, so basically being told that between 388,000 to 6 million, that should be taxed at 30%. Do we surpass the threshold of 6 million? Are we surpassing based on total income? Are we surpassing the threshold of 6 million, particularly on our taxable income? Do we surpass that? So we don't pass that. So we just use our taxable income. That should be 1338 minus 388. So the difference, then we multiply by 30%. So what is that difference we multiply by 30%? That difference we multiply by 30%. So when you have that, what do we get? We get what's called the gross tax. So the gross tax. The gross tax. So we get what's called the gross tax. The gross tax. So you get what's called the gross tax. So give me the gross tax. You get me the gross tax. Give me the gross tax. The gross tax. Tuko pamoja. Tuko pamoja. So we can decide to less personal relief or we hold on personal relief. Do you want us to less the personal relief? Do you want us to less the personal relief? So we can less the personal relief. Less what we call the personal relief. So when you less the personal relief, you understand it's 28,800. So this is what we call the net tax payable on total income. Net tax payable on total income. What is the net tax payable on total income? What is the net tax payable on total income? When you less the relief, personal relief for that year, what is the net tax payable on total income? That should be 310. 310, is this? This was 800. Was this? This should be 800 because it's 8. Is 310 the answer? Tafadhali. 310 is 310 the answer? We just confirm. If 310 is the answer, you give me a yes. Give me a yes if 310 is basically the answer. Tafadhali munipatie yes if 310 is the answer. Miriam, Lenovo, perfect Robert. So then tax on income. This is total income abroad and in Zambia. So we get the tax on income and in Kenya. And in Kenya. Tax on the income that basically is earned in Kenya. How much is earned in Kenya? So the income that is basically earned in Kenya is 720. Are we in agreement? Out of the two, the income that is basically earned in Kenya is 720. Are we in agreement? So we get the tax basically on the income that you say is earned in Kenya. Together, team, the tax on basically income that is earned in Kenya. Again, this is annual. So we say that the first 288,000 we multiply by 10%. So what is the 10% of that? Give me the 10%. So 10% of that, that should be, we have it as 28,800. Then you're being told that between 288 to 388, we have 100,000. That 100,000 should be at the rate of 25%. So 125%, we have a figure of 25,000. We have a figure of 25,000. Then you're saying that excess of 288 to 6 million, we tax at 30%. Is this income in Kenya surpassing a threshold of 6 million? Does 720 surpasses the threshold of 6 million? No. So just say that taxable income is 720. So we have 720. We say minus 388 minus a figure of 388 times 30%. So what do you get? What do we get? What do you get? Give me that. What do we get? What do we get? So maybe gets me 600. So what is the gross tax? Gross tax. Gross tax, what is the figure for the gross tax? Gross tax. So we have it as 153,400. Then you less what you call less personal relief. So what is the personal relief? That should be 28,800. So what is the net tax payable on income that is basically net tax payable? Net tax payable. What is the net tax payable on basically income that is earned in Kenya. So we have 124,600. Somebody says 124,600 together. We respond to the yes kama tuko pamoja. Tax on tuko pamoja. So what is the next step? The next step is basically tax on income and abroad. So remember, tax on income that is and abroad based on Kenyan rate. So that should be the difference between, what should be the difference? Tax on income that is basically and abroad. So tax on the income that is basically and abroad. Tax on the income that is basically and abroad based on Kenyan rate. Is the difference between, what is the difference, Miriam? That should be the difference between, total minus in Kenya. So that should be 310 minus 124. So what is the tax on income that is and abroad? So provide, if get the difference, so the difference is 185,400. So we determine what's called double taxation relief. Double taxation relief. So we compare, that is 185,400. How much was the tax abroad? How much was the tax abroad? It is given. How much was the tax abroad? How much was the tax abroad? So which one do we choose? Somebody, Chengo. Out of these two, which one do we choose? Which one do we choose? We choose the lower, which we understand is 78 Chachikana. But basically on conditions that we basically set for double taxation, we basically understood that the tax that is charged abroad is normally less than the tax that is charged in the country. In most cases, based on condition, this one on abroad should be lower than the one in the country. Then that is not over at that point. So then we are being told, lastly, we are being told, is it here? Lastly, we are being told. So we get what's called the double taxation relief due to Tamala and net tax payable, if any. So we can get the net tax payable. So we can get the net tax payable. So the net tax payable, that should be, we have it here. Tuko pamoja. So we have it as 310 minus less what's called the double taxation relief. So which we know that 185,400 you compare with 78 and the lower. So the lower is 78. Why am I not using the net? Why am I not using personal relief? Net tax payable. Why am I not using relief? Mbona sijatumia relief as this? Mbona sijatumia relief? Why have I not used relief? Why I'm saying as this, why do I not use relief? Because it's already as a tax credit, it's already factored. So what is the net tax payable? Some people will use this and less with this. 338,800 minus 153,400. Is it the same figure? 338,800 minus 153. Are we getting 124? Let's say, for example, you've not factored the relief, and you say 153,400 minus 338,800. Are you getting the same thing? Are you getting the same thing? I'm saying, let's say, for example, you've not factored the relief. If you want the relief to be one of the tax credit year, if you left this minus this, are we having the same thing? Because in some scenarios, some students will forget to factor this relief so that it uses the relief year. So do we get the same thing? I'm asking a question, class. Yes, we still have the same thing. But you'll only remember, you'll still remember that. What are you going to remember? You're going to remember in that scenario, now you're going to factor the relief here. Now you're going to factor the relief there. So what is the net tax payable when you less those two? What is the net tax payable? I want the net tax payable. So we have 232. And that's it. Tumemaliza hiyo swali. And that's it. Tumemaliza hiyo swali. And that's it. Na tumemaliza hiyo swali. Tumemaliza swali. Tumemaliza hiyo swali. As easy as that. Is that question not easy? Is that question not doable? Is that question 5/5? People are happy, 5/5. Yes, 10 entries that we should be able to have 10 entries there. 10 entries, we should be having 10 entries there. The first entry, this, then we have this. Those are 3, 4, 5, 6, 7. We have 7. We have 8. We have 9, 10. Or we can give one of the relief for 11. So any 10 times a half, that gives us 5 marks. That gives us 5 marks. Is it relatable to some of the things that you've been maybe asking on how to go about? Is it applicable? Ouko, is it applicable to some of the issues that you have? Perfect. Perfect if it is applicable. Can we do one more? Or we push that one more to our next class on Sunday? Because of time, we don't have time. If you pick a question, we will not be able to finish. Yes, next class altogether. I'll do more. This one was too short. This one was too short. This one was too short, but I hope you've understood altogether. I'll pick a question where we have also investment income altogether. But it's understandable. That was the main thing. So I want to say God bless you and God bless our class. Keep on supporting Focus. Yes, I will mention it. I'll give you that. I'll give you that. I'll provide that. Thank you. Thank you, Chi. Thank you. God bless you.
is how do we prepare the group account here? The first thing which is important for us to appreciate here is that the Kenyan currency basically is the Kenyan shillings. What is the name of the currency for Rwanda? The currency for Rwanda is known as what? Who can tell us here? The currency for Rwanda. The currency for Rwanda is known as what? Who can tell us? The currency for Rwanda. So the currency for Rwanda is known as Rwandan franc. Is known as what? Rwandan franc. Just like if you go to TZ, their currency is Tanzania shillings. If you go to Uganda, their currency is Ugandan shillings. If you go to Rwanda, they use a currency known as Rwandan franc. Rwandan franc. So basically, you can see that these two companies here, they basically prepare their financial statement using a different currency, using a different what? Currency. So this one, the parent company prepares financial statement using the Kenyan shilling. This one using the Rwandan franc. It is obvious that if you are preparing the group account, there is no be preparing the group account in Kenyan shillings. If the parent company is a Kenyan what? Company, it will be preparing the group account using the Kenyan what? Shillings. But that currency used by the parent company to prepare the group account is called the presentation